Welcome to Heresy Financial, everybody. I'm Joe Brown, and today we have a fantastic interview scheduled for us. We've got Dave Hunter, and he's a contrarian. He's the chief macro strategist at Contrarian Macro Advisors. He's got almost 50 years of experience, which is a big deal considering most people on Wall Street have been there for 20, maybe 30 years. And so the amount of experience and the markets that he has experienced and has lived through gives him a much wider variety of environments that he and experience that he draws on to come up with his forecasts. Strategist here, and so we're going to have a fantastic conversation. I'm very excited to talk to you, Dave. Thanks for agreeing.
Yeah, thanks, Joe. Thanks for having me on.
Yeah, absolutely. Well, like I said here, just wanted to give you a brief intro here. And you've been almost 50 years, and in that time, you've pretty much been a contrarian throughout your entire career. So give us a little bit of background for those of you who haven't followed you yet on kind of your career, and then what's kind of guiding your outlook going forward here.
Sure. Yeah, I started in the business in 1973, which was on the eve of the 1974 bear market, and probably until 2008 was known as the worst bear market we had seen in the post-World War II era. Pretty nasty way to start out, but it really gave me a good insight into capital preservation, the importance of not just looking at the upside, but also what your downside risk is. I started in a bank in their investment department, ran both bank portfolio and trust portfolios. So I had exposure to both bonds and stocks, which really helped me develop my macro views, being able to see both. And then after 8 years, moved on to run pension money, ran a Fortune 100 equity pension fund in-house for the company. Took them from 50 million in equities. They were really pretty negative equities when I went in, to 500 million, which ended up being 50% of their portfolio when I left. Had top percentile performance there. Went from there to Fidelity, and then ran ITT Hartford's active equity department, and then as chief investment officer along the way after that. So that was the first half of my career, and the second half of my career I've really spent as a macro strategist. Mm-hmm. And it really does help to have lived through these cycles. A lot of the people out there doing macro have read it in the books, and oftentimes I find what they got out of the books wasn't necessarily exact. There are a lot of nuances that are missed when history is kind of recapped. So I feel, cycle to cycle, I've learned different things each cycle. It really does add to the macro abilities.
Sure, absolutely. And you are a contrarian and have been that way for pretty much your entire career. As Ray Dalio likes to say, in order to make money investing, you have to bet against the consensus and be right. So what are some of the things that you look at in terms of, anybody can bet against the consensus, right? Like shorting Tesla over the last couple of years. But you also have to be right. So what are some of the things that have guided you in trying to make sure that it's not just, simply being a contrarian for contrarian's sake?
Yeah, great question, because you see it a lot today. Everybody wants to claim they're a contrarian. Mm-hmm. It's obviously been kind of put out there often that betting against the consensus is a good thing. And as I say, I'm not a knee-jerk contrarian. What I learned early on and through many years is that at inflection points, meaning at bottoms and tops, the majority at a bottom are bearish and the majority at a top are bullish. It's just investor psychology at work. Mm-hmm. So at inflection points, I tend to be very extremely opposite to the consensus. Sometimes almost the only one saying something, and people think you're crazy because you're saying completely opposite what seems logical. But during that middle between the inflection points, particularly as you move along in a market cycle, consensus is often right. So you don't want to be contrary when the trend is up and everybody's following the trend. I get a lot of criticism on or at least pushback on Twitter sometimes because I'm so bullish right now, and they go, you're talking about this, move to 4,600 on the S&P.
Yeah.
Everybody's joined you on that. You might have been contrary back in March, but you're not contrary now. And I'll say, yeah, that's true. But to get to that top, you have to have people, bullish. And so, it's really understanding. There are times to be contrary and times not to be on individual groups or different markets. It really is the same thing. You're basically understanding investor psychology when you're a contrarian, and understanding when everybody agrees with something, it's probably discounted in a stock or in a market. And when nobody agrees on it, or everybody agrees against something, it probably means that's discounted and it's a good time to step in. You also want to obviously look at technicals and fundamentals and what have you to make sure you're not stepping into an industry, a buggy whip industry that's going out of business. There are times when at the bottom it keeps going.
Right. It's there for a reason. Yeah.
There for a reason. Exactly.
Okay. And this is long term, right? Like, you've got the fear and greed indexes out there that show, that fluctuate day to day. This is more long term that we're looking at, right?
Yeah. As a macro strategist, I'm not trying to pick the day-to-day trading. There are times when I'll have, for example, in bonds, I probably was one of the very first several months ago talking about rates are going to be heading up here back to 1.5 on the 10-year. And I started saying that when the 10-year was at 0.6%. And when it got up over 110 towards 115, I said I wouldn't be surprised if we have a move back under 1 before we head to that 150. In other words, markets don't always move in a straight line, and typically don't. Well, obviously, I said that at 115. We're now at 126 on the 10-year. It's not meant to be a trading call. It's really just acknowledging that when everybody's on one side, don't be surprised if you get a little bit of a move back the other way. And so, the short-term stuff, I really don't try to, I don't want people thinking I'm trying to make trading calls, because I don't do that. But it's mostly intermediate to long-term.
Now, speaking of that, if we go back to probably towards the end of 2019, I remember you were calling for, you were still long-term calling for kind of a melt up, but you were saying we're going to need some sort of correction before that happens, some sort of fall in the market. And then COVID happened, and it was kind of like, well, that serves its purpose. Obviously nobody could have predicted that specifically. And when it was starting to fall, you were one of the only ones that was saying, hey, this is going to turn back around and start to go back up. Is that right?
Yeah, that was beginning of 2020.
Okay.
Because beginning in 2019, I was very bullish. I was contrarily bullish. Remember, we had the Christmas Eve sell-off in the market in 2018. And everybody got very bearish, and I came out at that point in time and saying, I think this thing's going to reverse very soon, and I stayed bullish through 2019. So, but in early 2020, that's right, I did say, the market was pushing. I can't remember now. We were, where were we? 3,200 maybe, pushing 3,250, and I said, there's too many people getting bullish here. We're probably due for maybe a 10% correction back under 3,000. Well, obviously it turned out to be down to 2,200, and I didn't call that. I didn't see the 34% in 3-week time frame that the pandemic gave us, but I did very quickly kind of take a look at everything. And I could have easily, because I was, even back then, was saying following the melt up, we'll have a global bust and a big bear market. I could have easily in March said, looks like that bust is coming early. Looks like the bear market has already started, because we just had a 35% correction or, bear market, and it's heading lower. But I took a look, sentiment was so negative, and yes, we broke some important trend lines, but not by, it was very short-term breaks.
Hmm.
So I stayed positive and said, okay, as negative as things look right now, I don't think we've seen the melt up yet. And I said, we're going above 4,000. I think I said 42 to 4,500 back in March, and stuck with that call. And then recently raised my targets, maybe in the last month. So I'm now looking for 4,600 on the S&P. And the more I look at my work, I think that's going to be conservative. I think we're going to push beyond that. The economy is opening up again. And you look across the board in a lot of groups, and there's runway ahead. And what I hear, there's, yes, it's, and this is the other part of contrarianism that people have to understand. You can have, for example, right now, lots of people raising their targets because momentum is up. The market's been moving up. So we have strategists on the street starting to use my numbers, 4,500, 4,600, but they're saying it in the next 12 to 18 months. I'm saying it for second quarter.
Gotcha.
So time matters.
Yeah.
And also at the same time that you're getting people kind of caught up in the momentum, so you can say, yeah, everybody's getting bullish. What I notice is also everybody's looking for an exit. Everybody's talking about, yes, this can go higher, but boy, is there a bad time coming. So in other words, yes, they're bulls, but they're very nervous bulls. At the true top, I think everybody's going to be all in and telling you why you're crazy to be, looking negative. So you have to there are nuances to contrarianism. You can't just say everybody's bullish, I'm bearish, everybody's bearish, I'm bullish. You have to look at what are people saying, and really what is their stance.
Right. So with that, then, with your target, being 4,600, and that's could potentially prove to be conservative. We've got gold that's been consolidating for 6 months now. We've got rates at record lows. The yield curve is steepening. What are some of these drivers that are going to push kind of this final melt up that you're talking about, that it's probably going to happen this year?
Yeah, I think there's an awful lot of people thinking this is just driven by Fed money. That the liquidity in the system is the only reason we're going up. And yet earnings are coming along. We've had, at least relative to expectations, we just had a very good quarter. And we had a very strong third quarter in the economy. Then it slowed down in the fourth quarter because the Fed backed off last summer. The fiscal stimulus stopped last summer. And we had the whole political thing where we held off on stimulus for many months that we probably shouldn't have. There was a lot of need, but we've now had the next round of stimulus, the 900 billion, and we're soon to have another, looks like close to 2 trillion. Mm-hmm. And so the economy is picking up on that basis, and it's also picking up because the cases are really rolling over. The vaccine is rolling out, and we're seeing, it looks like an economy that's going to open up in the spring and into the summer. So that's going to add another big jump to GDP and to various industries, business. And so you've got that going on. At the same time, you've got inflation starting to move up, and you've got to kind of realize that there's a period where inflation will become a problem, but right now it's adding to company earnings. It's adding to, it means the economy is picking up speed. So at least you're in a sweet spot where you can have inflation move up, you can have interest rates move up gradually, and you can, that won't hold back what is the good news, which is earnings and business is picking up. I think that's really the push. And of course, the psychology comes along with it, because I think we are going to see the slope of the market increase here into a parabolic. So I fully expect in the next 3 months that will be, as much as it seems like the market's up every day now, sure, it's going to get even more exciting in terms of or at least more, steepening in terms of bigger rally, sharper, faster. I mean, if people are kind of amazed at what we're seeing here, just wait. I think the next month or two is you're going to see that slope just straight up.
Sure.
And at some point that becomes problematic, but we're just not there yet.
Well, one thing that I love to see is whenever there are similar conclusions arrived at from kind of different starting points. And some things that I see in here that you're talking about are like, bulls climb a wall of worry. That's very traditional wisdom in investing. And then also bull markets don't die of old age. They die of euphoria. And so, like you said, there's very little euphoria system wide right now in the markets. You see that in isolated areas, maybe like Bitcoin, but you don't see, like you said, people are looking for an exit. So when that flips over, I'm really interested in what you see following this melt up, because you're calling for something that you're pretty alone in, which is a giant bust. Probably the worst in our lifetimes. And so can you talk about that a little bit?
Sure. Yeah, I call it the worst. What I expect is the worst downturn in the post-World War II era. So worse than 2008-9. First deflationary downturn since the Great Depression. So that's a biggie. And the deflation gets confused out there. People mix and match disinflation, deflation, et cetera. But deflation's a big thing. And real deflation, not just some prices are going down. So I call it a global bust because I consider it to be something that will have some of the feel of a depression, but happen at the speed of a recession. So meaning that I think most of the damage will be contained within a 12 to 18 month time frame. However, the damage will include some major bank failures around the world, big involuntary liquidation cycle, debt liquidation cycle, meaning lots of bankruptcies, both in the corporate sector and in the individual sector. We're in a funny place because I just talked about how the economy is picking up and things are going to look a lot better in the second quarter. But at the same time, it's a very bifurcated economy. You've got an awful lot of people that are going to food pantries that never thought they'd ever have problems with food security ever before. People who have owned nice homes that all of a sudden can't pay their mortgage. There's people out there that never, ever before last March anticipated that they'd ever be in financial difficulty. There's still 10 million people out of work and probably another 10 that are really barely getting by with what they are doing in terms of work. So there's still a part of the economy that's really hurt. Obviously, huge number of small businesses have gone under and many more are hanging on by a thread. I just, and you can go through obviously the restaurant and hotel industries, the tourist industries have, because of the COVID, have really been hampered big time, and many are barely holding on. So you do have that out there. At the same time, you've got an energy sector that's been beat up tremendously, and everybody forgets that it was only a half a year ago or a little more that oil was down in the dumps, and there was nothing good anybody could say about it. Now we're at $60 a barrel, and people seem to think everything's fine, but for two reasons. One, there's still a lot of shut-in oil. There's still a lot of companies that are not producing and have a lot of debt. And at the same time, you've got a Biden administration that's very anti-carbon fuel. So they're battling, something that could be depressionary if things don't turn around. So those are all, in other words, it's not an economy where everything is moving towards humming. It's really an economy where some things are going to look awfully good, and some things are going to still look awfully bad, and people may forget about it because they're focused on the stock market going to, major new highs. But that's a long way of saying there's a very fragile recovery going on, and it's going to be a recovery that picks up speed, but it's still going to be fragile underneath the surface. And with inflation, I think is going to move to a place that, the Fed can talk right now about we're not worried about inflation. We're going to look at year over year. It's probably another year before we have to even think about tightening. They can say all those things, and they may even believe them. I think they do. I think commodity prices are breaking out at such a speed here that you could find 3 months from now a very different tune coming out of the Fed. I think you could see inflation certainly pushing 3%. You could see it pushing 4% on some of the indexes, and the Fed can't just sit by, given the fact that they've pumped over $4 trillion into the economy in the last year as something that's unprecedented. They know when the economy opens up that at some point they have to drain liquidity. They know that the risk is that they overdid it. They can't, and they're right, they can't jump ahead of that because they really don't. You've got a fragile economy. If they tried to tighten now, they could have been very premature, and you could be right back down into trouble. So they don't want to tighten, and they're right to say we're not at that point now. But my belief is they will be at that point before the end of the second quarter. And I might be wrong about timing. It might, they might have more runway than that, but that's the big risk, is that as the economy really opens up, the Fed's going to feel more and more pressure to have to tighten. And tighten doesn't mean Fed fund rates are going up. I'm more of a monetarist than I am anything else. And it's money that matters, not the price of money. So, they may choose to hike a quarter or whatever, but I think the place where they're really going to be focused is in pulling liquidity out of the system, shrinking the balance sheet. And last summer they did it. People act like this has never happened before, and that they can't do that. Well, last summer when we were barely out of the second quarter swoon, they pulled 300 billion off the balance sheet. They tightened by 300 billion, which was called a pause because they wanted to step back and see what was going on. They wanted to, they had done a lot in the second quarter. So it's not unprecedented in this, pandemic for them to say, hey, we got to go the other way a bit. So sure. I'm guessing if you get inflation pushing 3% or higher, you could easily see 500 billion pulled out, and maybe more. And 500 billion into a fragile economy with as much leverage as this economy has on it can easily tip things over. And once you tip things over, you just don't know how fast, the snowball going downhill can get.
So if let's say they do that, and that's kind of the series of events on how this plays out, tightening to deal with some of the quicker than expected spike in inflation, perhaps in commodities, which tips things over and starts kind of a deleveraging, a deflationary death spiral. You don't think the Federal Reserve or any central banks are just going to stand by and let that unfold? That looks like a trigger where they'll step in and it'll make 2020 look small in comparison to the response. Is that right?
Yeah, well, I think what you're asking is the pushback I usually get is, the Fed will never let this happen. They'll step in before they ever let this turn into a bust. And my pushback to that is, you're underestimating the speed and magnitude to which an unwind can happen when you've got 250 trillion plus in debt around the world. You've got quadrillions in notional value of derivatives on the system. Those are two huge, unprecedented pieces of leverage that we've never dealt with in a downturn before. And they can speed everything up and make everything happen in a much larger fashion in a hurry. And I don't think we have any precedent for it. Now, the Fed and other central banks lean on precedent for everything they do.
Right.
In 2008-9, they had to pull out things that hadn't been used since the 30s. And this time around, they're relying on things that were done in 2008-9. But when they have to go into new territory, they do it. I mean, they've done some things this time, even in March, that were surprising. They moved pretty quick. But unprecedented moves are things where, a consensus building group just has a hard time moving quickly. They have to
Sure.
kind of contemplate things and study them and figure out. So, and when I say don't move quickly in something that can unwind in a matter of days and weeks, a month of hesitation is an eternity. So it's
Right.
not that the Fed's going to sit by for a year and watch things deteriorate, and then all of a sudden, when the market's down 50%, wake up. It's that we could be down 50% in a heartbeat.
Mm-hmm.
So and the market's not the economy, but they do tie in together. And I also remind people, I'm talking about a global bust.
Yeah.
Europe's in much worse shape than we are. Asia's very much in trouble in a lot of ways. Even Canada, their banking system was in much better shape than ours in 2008-9. They didn't have the subprime problem we had. Their real estate wasn't anywhere near. Well, fast forward to now, and our banks are much, they're still problematic in some ways, but they're much cleaner than they were in 2008. And Canada's in our shape now. They've gone way beyond. So there's a lot of places around the world besides the U.S. that could make this, exacerbate this.
And specifically, like in Europe, I know like some of the banks, like you said, are in much worse shape. Some of their balance sheets are 50 or close to 100 times their market cap, and so a domino effect where you have an insolvency show up in one area, spilling over, like you said, happened in a couple of days. The Fed and other central banks, they're more reactive; they're not proactive, and so even if they step in and everything is unwinding, the stock market, banks are close to failing or failing. You see them, let's say 10 or 20 or 30 trillion dollars trying to buy all of these assets that are failing. We've, like you said, 250 trillion is what they're dealing with, potentially, unwinding at once. And so they might try and deal with this, but it looks like that would probably be, by the time it becomes enough, it's already too much, leading to the next kind of start of the next cycle. Is that right?
Yeah, what I'd say is there's just enormous counterparty risk. So if there are problems with the European banks, it's going to spill over into the banking system around the world, and particularly U.S. banks. So yes, and it just I think when you've got frankly, this is a Ponzi scheme. I mean, this thing is leveraged up to the hilt in so many ways. When they, as we know in Ponzi schemes, when they start unwinding, it's very hard to stop them.
Right.
Now, what will stop it, and what separates me from the real gloom and doomers out there that might be calling for the end of the world this cycle, that we're heading into a depression and things are almost over. What I say is there's a recovery cycle on the other side of this bust, and like I said, this bust might only be most of it contained within a year. But the reason I'm positive we have a recovery cycle and that there is another cyclical upside is because in deflation and very low inflation, but particularly deflation, central banks have unlimited capacity to print money because there's a lagged effect to when that will really cause problems inflation wise. So if we're heading into a deflationary bust, and the banking system's imploding, the financial system around the world is imploding, they're going to be able to, the only tool they have that they can move quickly to stem that is money. And is printing. So
Yeah.
if they start shoveling money into the system, and not just Fed, but the ECB, the Bank of England, Bank of Japan, People's Bank of China, et cetera, Bank of Canada, you will see, I think, the Fed's balance sheet alone, it might take as much as an expansion to 20 trillion, maybe even 30 trillion in the Fed's balance sheet to to stop that free falling financial system, because the domino, as you said, it's a domino effect. It goes from one to the next to the next, and the only thing they have that can move quickly is QE or shoveling money in. You can't get fiscal measures out there fast enough to deal with something like that. So it's going to be, print money and ask questions later. And by the time, and don't forget, there's a lag to when that all has an impact on the economy. By the time they realize they've done enough or probably done way too much, it'll be, they'll be well into it. So, and then again, not immediately, but 2 and 3 years down the road, you've triggered a real inflation crisis because of all that money. So I mean, that's the scenario. How it plays out, I find a lot, particularly retail followers on Twitter, think you can precisely call this stuff, and they want to know which month it's going to happen, and and stuff like that. And it's just not that. I can put out targets of when I think the market might peak, or when I think the bust might start. But we're talking about things that there are a lot of variables, and it's as I say, I'm calling for the top of a 39-year secular bull market. I don't worry about which month it's going to end. It's just knowing that we're moving towards that, if I'm right, is a big deal. And same thing, calling for a bust. Well, there's plenty of policies that could intervene and push it out or shorten the time frame. But as best as I can see right now, we could see a market top as early as second quarter, and we could see a bust start before the end of the year. Might be end of third quarter, might be beginning of fourth, might take longer, but that's a lot depends on when the Fed has to intervene, when things start heating up such that the Fed's starting to have to lean against it. Those will be, I think, your first signals that there's trouble ahead. And don't forget the first response. The minute the Fed stops easing and starts doing something in terms of pulling money out, that doesn't mean everything happens all in that next few days. So there's a process. Everything happens over time in a process.
Well, 3 things then. It looks like we've got some exciting market times ahead of us, to say the least. 3 things that I'd like to kind of hear your thoughts on to wrap this up: gold, Bitcoin, and cash. So I've heard your thoughts on gold, that yes, it will probably go down in the deflationary, that the bust, but when you compare it to other things, it probably won't be as bad, which means from a relative standpoint, it could be more of a safe place to hide your money than stocks or other things. Is that still your view on gold going forward?
Yeah, absolutely. Just right now I'm very bullish. I mean, I'm calling for 2,500 on gold here in the next several months, and right today it's being beat up, I think, and as a result of that, there's lots of people calling for lower gold, etc. I think gold looks great here. I think gold's going to move up with this final parabolic move in the stock market. Inflation is moving up. Interest rates aren't moving up as fast as inflation. That means you get lower real yields. So even if nominal yields are moving up, which is generally viewed as bearish for gold, if real yields are still moving down, that's bullish. And I think you'll see gold and silver do very well here. But yes, when the bust hits, I do expect a correction in almost all assets, with the exception maybe treasuries and the dollar. So I do think gold will step back. If I'm right that we go to 2,500, I'd be surprised if we see gold much below where we are now. In the bust, it's possible it could go down to say 1,500 or something. I'm not that clairvoyant, but I do think it will be much less than the stock market. And then coming out the other side, I think gold will be one of the precious metals in general will be, along with commodities, be the lead sectors in the next recovery cycle. It won't be growth stocks. It won't be the the social media stocks.
Mm-hmm.
It will be I think very much led by commodities.
That makes sense. Any thoughts on Bitcoin or cryptocurrency in general?
No, I don't follow Bitcoin and I don't follow crypto. I really feel like there's too much hype around it, frankly, for me. I also don't really consider it a macro story right now. It's more of a market story. It's feeding on momentum. But there's a lot of well-known hedge funds, et cetera, who are kind of, this is where they're making their mark right now, is saying, I saw this early and I love it. Da, da, da. And everybody's kind of playing leapfrog of who can call how fantastically higher it's going to go.
Yeah.
That's just not the makings of, I think, a solid market. And frankly, it's so untested. Let's see how it does in a bust. I heard one of the Fed officials on today saying, yeah, back in Civil War, we had, lots of private currencies and they didn't go so well. People didn't like the fact that, every currency was its own thing and prices were all over the place. I think that's a reasonable point, is that who knows whether crypto survives, as this. I think it's really driven a lot right now by the distrust of the Fed and the distrust of institutions in general. This is something outside the system, so it feels good. But boy, there are lots of ways this thing can be manipulated and take on a life of its own. So it's just not something I'm comfortable with. But I'm the first one to tell you I'm far from an expert on Bitcoin. There's probably lots of things that people could tell me I don't know about it for sure.
Yeah, sure.
So I just don't follow it.
Okay. Well, and final question. Do you think fiat currency, like the dollar, survives the next 10 years in its current form? Do you think central bank digital currencies replace it? Or do you think that we go back to some sort of a global gold standard? What do you think happens with the current?
Yeah. Okay. So I do think the dollar's not going anywhere soon. So certainly for the next 5 to 10 years, I think, or certainly the next 5, the dollar's not going anywhere. It's still going to be the primary trading currency out there. I think I do have a bearish view on the dollar once we get beyond, the bust is going to drive it up. So I have a view of the dollar going down, the dollar index going down to 85 here. I've been one of the big bears on dollar the last year. I believe it can get up to 120, maybe even 140 in the bust as people run back to the safest currency, the most stable currency in the world. And then from there, I think it's all downhill over the course of the next 5 to 10 years. The dollar can get down to 50, maybe far lower than that. I don't know, but there's problems out there for the dollar. And in that time, and I'm talking about really beyond the mid-decade, maybe late this decade, at that point, maybe there's going to be some change, a basket approach, or maybe not. Maybe the dollar will carry us right into what I think is going to be problematic in the 2030s, what could be a depression by then. So I don't pretend to know exactly, but I think for the next 5 years, the dollar's going nowhere in terms of it's going to remain the primary trading currency out there. Digital currencies, I don't know what China's going to do. I don't know what, Europe's going to do, et cetera. I'd be much worried, by the way, I'd be much more worried about the ECB, if I were the ECB, about the euro surviving this cycle. I think Europe's got so many problems out there, and I'm not sure what happens with the euro here. It was a flawed effort from the beginning when you have such diverse economies as Germany and Italy and Spain and what have you, and trying to fit them all under the same umbrella. So I think there's more questions there than there are with the dollar. In terms of gold standard, as I say to people, if we followed the advice of some of those that say we should be going on the gold standard here, and I get it. I mean, this last several decades, last 30, 40 years, we've gone off the rails in terms of mismanagement of our currency, mismanagement of our debt, mismanagement of our economy. So if you could go back, if you had a time machine, you go back 40 years, I'd say by all means, I want a gold standard. But to do that today, you basically would take away the ability to handle what I'm describing the bust is going to look like. And the only thing that's going to extend this is the money. I'm not endorsing it. I'm not saying it's going to end well, but if you went on a gold standard now, we'd all be in caves. We'd all be living in caves. I mean, you take away the ability to inflate away that debt, and you have nothing left but an economy that's going straight down. So, I'm not a believer in this grand reset. I don't think that's going to happen. I don't think it should happen. But mostly, whether it should or shouldn't happen, I just don't think it's going to happen.
Sure.
So, what comes in, from 2030 and beyond is a whole different story. I think anything could happen then, because I think, like I said, it's a Ponzi scheme. We can kind of run it up one more time. But I think by the time we get to the end of this decade, this whole world is in for, real trouble. You can't sustain this indefinitely.
Sure. Yeah, absolutely. Well, fantastic. Really appreciate the insights. If people want more and want to follow what you're saying, where can they find you?
Sure. Probably the best way to see my work or see my views is on Twitter. So at Dave H. Contrarian is my handle there. And then I also publish a quarterly investment letter that if they reach out to me, direct message me on Twitter, I can give them details on that. It's I just want to let people know there is a fee for it. It's not free, but it is something that's available if people are interested.
Okay, so follow you on Twitter and DM you for the newsletter, and I will link both of those in the description below.
Sounds good.
All right. Hey, well, again, I really appreciate it. Fantastic insights, and thanks so much, and good luck.
Yeah, thanks, Joe. You too, and enjoyed it. Thank you.
All right. Have a good day.
You too.